Welcome back to the module. Today we're going to be talking about personal finance. The learning objectives for today's lecture are to be able to apply a balance sheet and income statement basics to our personal financial planning. We want to be able to create a budget using realistic estimates for a new pharmacy practitioner. We want to also be able to compare job and career strategies on long-term financial success, or at least through a financial lens. So remember from previous videos that we talked about the balance sheet equation. Now, often written as assets equal liabilities plus equity. I often shift it around and have assets minus liabilities equal equity, just to kind of demonstrate that, you know, your equity or your net worth is sort of what we're often looking to estimate. And in our previous example, or in our previous lectures, we also went through kind of a house example. So let's show that, you know, before buying a house, and again, thinking that maybe you've saved up $20,000 in cash from working a part-time job while in school, maybe some extra student loan money that you have left over after graduation, and maybe a few graduation gifts from your family. And over the time, you've amassed about $200,000 in student debt, and you still want to buy a house that's also valued at $200,000. So before you buy the house or do anything, right? So you've got $20,000 in cash, so that's our assets. You've got $200,000 in student debt, so your equity, your overall net worth would be, in this case, like a negative number, right? Negative equity, negative $180,000. So we decided to buy this $200,000 house. And in this case, I think in the previous examples, I took out transaction costs, which is really not realistic. Typically, you're going to have some sort of transaction costs in this type of transaction, you know, just through inspections from the house, maybe interest or other things from the bank, or other fees that go through getting the bank loan. So it's really impossible to go through purchasing a house with, you know, pretty much zero transactional costs. So you're going to spend something in the purchase. So let's just assume it's an additional $10,000. So after the house, your assets, liabilities, and equity would look something like this. So you purchase the house that's valued at $200,000. So your total assets would be worth what you could sell the house for, $200,000. Now remember, you no longer have cash, right? So you use that cash as part of it as a down payment, and then some of it went into the transaction cost. So you took on an additional $180,000, or I guess, I'm sorry, $190,000 in debt regarding the regarding the loan for the house. And so, you know, when you add up the liabilities, so now you originally had student loan debt of $200,000. You added on another $190,000 worth of, cost and everything for the house. Now your total net equity is negative $190,000. Now you see your equity went down, so you did go down some, but it didn't go down a lot. So it only went down really the cost of the transaction itself, because you do have a house now that's worth $200,000. Just know that I think a lot of people, when they first buy their house, you know, they often joke, well, you know, the bank owns it. And that's because that you do have that substantial liability that you know, you have to start working on paying off. So, right, so how do we increase our equity? Well, in this case, we've got a big house loan and a student loan that we've got to work on paying off. And we can also build additional assets like saving cash, or the value of the home could also go up. But remember, when your home increases in value, you're not going to realize that value until you're ready to sell the house. So when you think about your equity, I think it's important to remember that whatever you have invested in your house, as long as you need a place to live, you know, it's not like you can do a whole lot with that asset. Using that logic, or as we start talking about like your house, so let's talk about different asset categories in terms of financial planning. And this is a table that you can have. Don't take this from me. Go to www.irs.gov. Check out some of these, some of the things that they have about about these different retirement plans and whatnot. So, you know, check out the pros and cons that I've listed for you, but do your own research, okay? So for your primary house, and that's the house that you live in, the advantage of owning this as an asset, actually owning your house versus renting, is, well, you need a place to live, so you're going to be spending money on it anyway, and it forces you to save, right? Because as you're paying off the house, you're taking your cash and you're putting it into another asset, and so it's like you're not the cash that's in your bank account that could be extra, that you're trying to pay off your house. You're not using it to go on trips and do other things. Now, one of the advantages in the past has always been around the interest on the loan for your house is often deducted from your income tax. Most recently, since in the 2018 tax bill, I guess the most recent tax legislation, I noticed that with the additional deductions people can take now, or I guess the additional deductions for individuals and married couples, your standard deduction may be enough that the interest on your house may not make that big of a difference. So again, check. Each of you are going to have different situations, different tax situations upon graduation. So if you're not good with taxes yourself, you need to definitely consider working with an accountant. So some of the disadvantages of thinking of your primary house as being your an asset category. When we think about our house, it's really tough to control our emotions. So when you purchase a house, it's about what you live in. You kind of make it your own. Think about if you have kids and you start raising them, and you might make little marks on the door saying how tall they get. There's like an emotional attachment to it. When you don't really look at the house as an asset, as a piece of property that is financially important for your livelihood. So you likely will overvalue the house based on what you can actually get for it. And so anyway, I think it's just something to think about when you're purchasing a house. You do need to remember that this is a major asset, and typically, when I say major asset, it's typically one of the assets that most families, like, that's their biggest asset, is the value of their home, because they don't have a lot of other savings and other investments. One of the cons is, and again, this is like if you're not doing Airbnb or VRBO or doing some other things to get income off of your house, it's typically not producing an income or a revenue. Also, the interest on your liability is still a cost. So, I always going to say, do the math. So it's an advantage to take the interest off of the loan on your personal income tax, but it's not like a one for one. So, when you take out a loan, the loan's going to have, again, that interest itself. So say you paid $1,000 in interest on a loan for your house. Your deduction or your income tax offset's not going to be equal to $1,000. It's going to reduce your income by $1,000, but the amount of tax that you might save, maybe it'll be like $300 or $200, depending on what your effective tax rate is. So just know that do the math, figure out what your savings or what type of benefits you get from taking out a loan, and then consider what the cost of the loan are, and we'll have an entire video on debt. The next asset category I like to talk about is the investment property. And this is when you buy a second property and you're looking to have renters, and so you're trying to basically produce a cash flow every month. I'm calling it passive cash flow, but you'll see one of the cons is the time and effort and energy that you might have to put into it in terms of managing it, especially before you get it rented, or when if renters call you and there's a leak or there's some issue that you got to address. Are you managing it, or do you have a contractor, a handy person that can fix a lot of those things? Another advantage, again, is another forced savings, because if you start out taking a loan and you're putting money into that, you're putting money on the loan to pay off the loan. Again, it's forcing you to basically pay off another debt while you have this property that is of value. So there's several retirement account strategies that are, we think of our assets as well. So besides the house, as you get older, and if you've worked for 20, 30 years, you start building up investment account funds. So a lot of places of business have like a 401k, 403b opportunity. So when you go to invest, there's different pros and cons, or there's different pros and cons for each. And so, just I have this slide for you to take a look at, but I really think you should go to the website and check it out yourself. And again, actually, I'm trying to think when I updated this last, because the contribution limits when I did this slide were $5,500 a year for the IRAs, but that may have changed. I'll have to double check, and we'll double check in class and discuss whether or not if that's something that may change. Just know that there's typically a contribution limit. Also know that there's typically penalties if you withdraw funds from any of these accounts before you're age 59 and a half, unless there's some exceptions that you can read up about. So when you put money in these accounts, the incentives are for you to leave it there. And so it's, again, kind of forcing you to save, forcing you to not touch it and not go on trips or do fun things with it. So it's probably more, I think these are good, like nudges, nudging you in the right direction. So then we get into other investments like mutual funds, individual stocks. Now your retirement accounts, your IRA accounts, and 401k, 401(b) accounts, depending on the way your employer has it set up, you likely will have these invested into mutual fund like mechanisms. And so all this is like, if it's invested in the market, like a money market account or whatever, it typically means that it's spread out over a lot of different investments. That reduces the risk of, say, like one company going under, right? So that's the thing, is that when you get into investing into individual stocks, so when you purchase one company, as it goes up or goes down, you're going to be exposed to all the good and bad of that company. And so that's how it can yield higher returns, right? Imagine if you had savings when you were, so a lot of you were born in the late 90s, early 2000s. Imagine if you took every bit of allowance that you had when you were 7, 8, 9, 10 years old, and every time you got your allowance, you just went over and put it into Apple stock. So mid 2000s, 2010, 2011, you were just buying one share of Apple stock every time you could. If you looked at it today, that would be pretty awesome. You'd probably have a pretty nice little savings built up, especially just in this last year for like one stock. With that said, during that same time, if you had invested in, I don't know, say, trying to think of a good example at the time. There's a lot of companies that have just gone under over time. So you can go look to see companies that fail, and so that's the risk, right? Is like if you invest in one company, you're putting all your eggs in one basket, right? So that's sort of why individual stocks can be fun to invest in. Just know that you're likely gonna, you're also likely to take a bigger loss. And another disadvantage is that you probably don't know enough to invest in stocks on your own. I spend some time playing around with stocks in the stock market, but it's not my day job. It's not something I can work on every single day. I can't put 40, 50 hours a week in researching and investing, really being an educated investor. So I consider my individual stock account, where I buy and choose single stocks, I consider it a fun account. I don't consider it an account that is like my main retirement. So I recognize that I'm taking bets, if you will, on companies I think for various reasons will do well, but I'm not thinking of it as like the thing that's going to help me retire one day. I think the big takeaway is that there's a lot of different assets for you to consider, and this isn't a full list. I mean, I'm sure there's a lot of other things you can think about. Again, it's don't forget that cash is a major asset. Cash is the most liquid asset. So having cash just in savings, checking, in CDs, very conservative investments that you can access quickly if you need it. Having a large amount of cash at your disposal when you need it is really helpful, especially if bad things happen. And we'll talk about that in a minute. So we talked a lot about the balance sheet. Now let's shift gears and talk more about our income statement. Or in the case of personal finance, we're going to talk about it in the context of building a budget. So remember from our previous videos, we talked about revenue. So, revenues is the inflows or other advancements of assets from delivering goods and rendering services, right? So as a business, you think about revenue as when you produce a good, sell a good, provide a service, you take money from a customer and you record that in your income statement as a revenue. Well, for an individual, then this is, we don't typically call it revenue, we call it our income, which can be kind of confusing because remember we learned about income in the income statement as being sort of the bottom line income, and I'll talk about that in just a second. We also talked about expenses, so these are our outflows of using up our assets. So when we spend our cash in order to do the things that we need to do. So let's compare the two. Let's compare an income statement for a business and for personal finance. So when we talked about it in the business context, the very top of the income statement is revenue, and you would compare that to what we call wages for your personal example. So wages or your salary. So in the business context, after you've made revenue, you typically sold a good. A lot of businesses sell goods, so you'll take out maybe like a cost of goods sold, and that leads to this little number called a gross profit. On the personal side, when you take out some of those pre-tax deductions and other expenses, you get this thing economists call disposable income. And from your disposable income, like your gross profit, that's what you pay your operating expenses for. So in this case, for a business, operating expenses, wages, your utilities, your rent, all those things for your building, that's in your operating expenses, and that yields that income before tax, or we learned about EBITDA, right? Earnings before income tax and amortization and depreciation. So on the personal side, your operating expenses are things like your housing, your car payments, your food, your clothing, your all your health expenditures, anything that keeps you functioning, right? Keeps you alive. How do you operate? And from that, we are left with a discretionary income. And the discretionary income is what we have for all of our fun stuff. So that's like for vacations and whatever. So they're very similar, business and personal example, but just know that you're paying taxes for people. We typically pay taxes on our wages, and it's not so like it's a bigger number than when we're a business. We actually take we actually able to take out our operating expenses before we pay taxes. So for a person, you typically, if you have a W-2, you're working a full-time job, like say as a pharmacist for a retail chain, you'll have your salary, but like you'll typically not deduct things like like your rent or your house. There are, again, when we get into taxes, like there are incentives and deductions for you for your house, but it's not considered like an operating expense. So in my opinion, like when you think about it, there's a lot of advantages for owning a business in terms of the tax code compared to being just an individual. So let's apply this to someone making $100,000 a year. So this is that kind of maybe that position first out as a pharmacist, and I guess pharmacist salaries, depending on where you live, can range from 80, 90,000 all the way up to 130, 120, 130. So typically when we think about our salary, we don't just get $100,000 at the first of the year on January 1st and say, all right, here's a $100,000 check, good luck. No, you get paid, bi-weekly or monthly. And so since our bills are often in a form, or monthly, let's just look at this salary every month. Okay, so let's do wages per month. So for $100,000 salary, you're going to make about $8,300 in as your pre-tax wages. Now let's say you put in maybe 5% of your monthly salary into a retirement account, like a 401k. And then from that, you're going to pay a tax or a tax rate. And so I'm estimating around 28.5% based on a 30% tax rate. But remember that because you gave up about 5%, about $400 pre-tax into that retirement account, your 30% tax rate is on a smaller number. So that's one of the advantages of putting into a pre-tax retirement account, is that you're basically reducing your taxable income. So that's why if you had a 30% tax rate, the effective rates, see on the far right side, is 28.5. All right, so then maybe you'll have some insurance deductions that come out of it. So health insurance, maybe dental, vision, whatever you sign up for. And then that leads to your disposable income. So what you'll find for most pharmacists in this salary range is that they'll probably be working off of about $5,000 to $5,200, $5,300 a month is about what their budget might look like for a single pharmacist, which is, can be pretty good. So if they were to then think about housing, transportation, and food, so our operating costs, now I pulled these numbers, so the numbers that I estimate here are based off of the Bureau of Labor, Statistics. So the 29.9, the 16.4, and the 11.4%, those percentages were pulled from the Bureau of Labor Statistics for individuals that make about this amount of money. So if you make about $100,000 a year, you're going to be spending anywhere from $2,000 to $3,000 on your housing. And this is not just your mortgage. This is like mortgage plus utilities and just everything else to keep the house going. So your mortgage may only be $1,500, but maybe you have an extra $700, $800 in expenses. Transportation, you're thinking, gosh, well, I don't spend $1,300 a month on my car. My car payment maybe is only $300 a month. Well, even at $300 a month for the car payment, once you factor in insurance, gas, and repairs, so you got to budget in, when the car breaks down, you might be pushing closer to $1,000 than you think. Food, groceries, dining out, it's about 11% in this price range. So for a single person, $950 a month. Now, that may not seem like, or for some of you, it may seem like a lot, especially like while you're in school. When you get out and, maybe you've got a little bit more money, you're thinking, okay, I can go out a little bit more, nicer dinners or, whatever. I guess depending on, and if you have a family, this may seem like not a whole lot of money at all, because a lot of families are feeding 3-4 people. That's not a whole lot of money. So at the end of the day, what we're left with is about $400. About 5% of your wages is left over after all of this for your discretionary income. And for many of you, you're thinking, well, wait, what about student loans? Well, they're not in here yet. So that's one of the things that's one of the things that's probably going to impact your choices around things like housing and transportation. Because instead of you spending $1,300 a month on transportation and $2,400 a month on housing, you're probably going to be in the boat where you're going to have to spend a lot less on those two components until you get your student loans paid off. So that's just something to think about. And when we talk about wages versus income, pharmacist wages have gone up. So we have seen on the median wage, so this isn't everybody, but this is the median wage, is that we do see an increase. However, the student loan burden has increased dramatically. And so I actually did a study a few years ago and demonstrated that if you're focusing on that discretionary income that we talked about at the very end, that it's about 27% less in 2014 compared to 2008. So for many of you who are graduating 2021, 2022, if that trend is still continuing, that that it's going down a little bit, or at least, and I believe it's flatlined some. I don't think it's getting worse. But you all are probably making less than what pharmacists were really making or putting in the bank 10, 12 years ago. And not to get discouraged, it's just that this is something that I think we all have to discuss. And as a profession, it's like, look, we're putting a lot of burden on our students in the form of student loans, and the wages aren't continuing to go up like the same rate of our debt. What's more likely? Are you going to increase your income? And so from that, can what are your prospects of getting a raise, going for a higher paying job, maybe working a second job? A lot of people are big on having like a hustle, maybe adding some passive income, buying a rental property or whatever. So, those are things you can do to increase your income, to improve your overall income statement. But what about decreased spending? Just cutting back on extras, trying to eat out less, fewer vacations. What can you control, each year? And so typically, while we think getting a higher paying job or getting a raise is something that might be feasible, maybe it's not something you can do in 1 year. It may take 2 or 3 years to do that. Whereas your spending can be controlled, every single day. So think about that as you're building your budget, and a lot of it's about discipline. Also kind of giving yourself a little bit of a break and budgeting in some fun money just so you can kind of let loose and not worry about all the savings that you got to do. But if you don't budget that in, it's easy to sometimes let a lot of money get turned into fun, and then you're not saving anything. All right, so the last little area I want to talk about is maybe how you could evaluate two different positions. And so I just want to ask, and maybe this is something we can talk about in class, is maybe there are two different job opportunities or two different pharmacist situations. Let's look at these two pharmacists. So the pharmacist on the left has a $150,000 a year job, debt of about $300,000, whereas the pharmacist on the right has about a $100,000 salary, so significantly less, right? But zero debt. Now, I didn't give you all the information, right? I just gave you some couple pieces of information. I just want to ask you, how would you evaluate these two? Like, what would you say about either scenario? Because a lot of you may be in situations where, as you think about, like, maybe you're a lot like that pharmacist number one, that, gosh, I'm going to, have $300,000 worth of debt. How do you know what's good or what's not good? Like, does that mean you need to make a lot more money because you have more debt? And that's sort of what this whole module is meant to kind of talk, or we're supposed to be going through and talking about, is how do you address, those things that are setting you back. And then, as you try to work as a pharmacist to increase your income or do more to make a little bit more money to cover those things. But then also, like, again, comparing these two, what would you look at? Would you look at, so obviously the one on the left has higher wages, but we don't know anything about their operating expenses, right? We don't know if they are, if they're spending a lot less on a house or a car. So maybe with that big salary, they're going to be able to pay off that $300,000 debt a lot faster. So we don't know. We also don't know if pharmacist number two that currently has zero in debt, are they going to take on debt, or are they saving anything of their $100,000 salary on that, or are they just spending? So, definitely not enough information in here for you to compare the two. I just want to throw some numbers out here, let you start thinking, like, what's good, what's bad for each of you. If this also is important for you to think about, just given the two scenarios and not knowing anything, what would you want? That might tell you a little bit of something about yourself. What is important to you? Would it be better for you to make more money, or would it be better for you to be out of debt? Is it both? Like, what do you value, right? So your reaction to these two pharmacists might give you a little insights on your own personal values. Now, if that pharmacist that I gave you on the right, or on the left, I should say, was working in San Francisco, and the pharmacist on the right was working in Baltimore, you'd say the person in Baltimore is way better off, right? Now, again, this is just using a cost of living calculator. Now, if you're making $100,000 in Baltimore and you move to San Francisco, it's definitely going to be a challenge because the housing is incredibly higher. So, to have the same exact house you have in Baltimore and San Francisco is a ton more. And if you've never looked at properties in San Francisco or in certain areas like Washington, D.C., Manhattan, it's like they skyrocket. It's wild. But the other cost of living components are a little bit higher as well, too. Groceries, utilities, transportation, healthcare, all these things are a little bit higher. So something to think about. Now, do you need to make $177,000 in San Francisco to be equal to Baltimore? No, not really. Actually, you need to make different choices. It just means that maybe the house you get in Baltimore, you could have 3 bedrooms, and the one you get in San Francisco, you're only going to have 1. So you'll likely make different choices. But just realize that cost of living is a major component of how we evaluate. So don't just look at. A lot of people like to look at their salaries and say, oh yeah, I made $200,000 last year. Well, why when we talk about salary, why do we talk about it in that frame? Like why would we just refer to our salary when really we need to be talking about how much we're saving, or what is our net, right? What is our discretionary income at when it's all said and done? If your discretionary income was $50,000, and we had that discussion, well, I had $50,000 last year to do fun stuff with. That sounds pretty awesome, because that actually might be a lot more than making $150,000 but then having no discretionary income because of your other spending. So that gets us into thinking about the ways we evaluate different numbers. Okay, so I'm not gonna test you on this year. I used to test on this kind of stuff quite a bit. So we go into things like solvency, liquidity, profitability. So like solvency is talking about your ability to pay off all your debts. Okay, so your solvency is really that assets and liabilities equation. You're saying if you sold all your assets, would it equal, would you be able to pay off all your debts and have something left over? Your liquidity is more about short term. So this is back to where I mentioned earlier in the video, we talked about cash being more liquid than, say, your house, because you can't just sell your house in a moment's notice to go buy groceries. But your cash, you can just move around. We move from checking and savings pretty easily, or carry it in our wallet or whatever. It's easy to use. So what is your ability to pay off short-term stuff, pay your bills regularly? You could have a ton of money in investments, but if you can't use the money and it's all tied up, you're not liquid. Anytime you have some major issue like a car accident or something, you might find yourself in trouble. And then the third, talking about profitability, that's referring to, based on your revenues, you take out all your operating expenses. Do you have anything left? Is there like a profit, net income, EBITDA? Those things we learned about in the previous section on accounting for our income statement. How do we show that you're really profitable? And so in the personal income sense, we would say, is your discretionary income, is your discretionary income up to 20, 30, 40% of your total income? I mean, if you get it to where your operating expenses to live and taxes and everything else that you pay is only, half the story, or 50% of your income, now you got 50% of your total income that's for fun, that's in that discretionary. So anyway, being more profitable with your income or with your salary means more that you've got more to play with. And whenever I talk about personal finance with students, I typically get like 10 different versions of this questions. How do I pay off my student loans? So, there's some things that, I'm not going to go into all these in this video. Just want to kind of share there are some loan forgiveness programs, the federal government. There may even be some, depending on if you decide to go in the, maybe with the military, or there are definitely options for loan forgiveness. They're difficult. I wouldn't say that it's easy to get your loans forgiven. There's an income-based payment plan. There's different types of interest to consider. There's forbearance and deferment to think about whenever you're in a tough spot, lose a job, or having trouble finding a job. And then consolidation always comes up. Should I consolidate? Yay, yes or no. My answer to all of these questions, or no matter what, is you've got to take some time and do the math. I created a whole video for you on principles of debt, and I really want you to spend some time. If you stop this video now and just switch over, just start watching and rewatch the one on debt. I think if students could really grasp and have a good understanding of amortization schedules, how your loan principal, your interest rate, and your term are how they influence each other and how they influence the payments that you make, I think you'll do very well, or at least you'll have a good plan for what you do with your student loans. So that leads us to one of our final things for this module. We're going to have a case. So yeah, I drew some inspiration from a guy I know pretty well. So obviously me a few years ago. I graduated with a PharmD and an MBA. Unfortunately, had quite a bit of student debt. I did get a pharmacy management job pretty quickly out of pharmacy school, thanks to the work I had done with Kroger, and it done quite well. So I got a good opportunity. Had normal bills, cell phone, utilities, that sort of thing. Was looking at renting, and I was renting, and then decided whether or not I wanted to buy a house or a condo. I like to do things in my free time. I would play golf, and golf's not a real cheap sport, so that's something you got to be careful with. Like to go out with friends, out to dinner or whatever. Like to be social. And also, I met a person too that you all might know as well. We started dating, and thinking about saving up longer term things as you're thinking about other personal life stuff. So all of these variables are at play. And in our case, I'm going to give you a lot more specific numbers for you to work with. And so part of your case is going to be really building out an annual budget for this hypothetical scenario, right? So again, I kind of chose to do this rather than you all putting in all your own numbers. I don't want you to feel like you have to share your stuff. So I'll share mine, and you're more than welcome to kind of see what I had to deal with, and you can make a plan for what you'd recommend this person to do, and maybe we'll talk about some of the good and bad. I'd be happy to share some of the things I did well and things that I didn't do so well. So hopefully it'll help you as you apply it to your own life. And I'm hoping that the tools that we'll use in this case will be something that you'll use in the future. So we'll hopefully have a good discussion on this in class. But if you have more questions, don't hesitate to shoot me an email, and we'll talk soon.